after taking off the discount. Now some other cases here besides discounts may happen. Other cases, let's say I purchase a batch of inventory. By the time I receive it from UPS or other FedEx transportation companies, by the time I receive it, I open it up and there's already damaged goods in it. So in this case, again, it depends on how serious the damage is. Sometimes the seller may want me to ship back the goods to them if they think that they could fix it, resell it to other customer. Other cases, let's say it's perishable items and it's completely broken. Okay, so in that case, we may likely hold on to the goods, but the seller will be giving us a refund, an allowance. Okay, so there are two cases here, but shares the exact same entry. In purchase side, we don't separate the case of whether or not we actually give back the inventory to the seller. If it's just an allowance, that's fine. If we actually return the goods, both cases here we share the same entry to capture the effect. Okay, we have to recognize that in reality there could be two different cases. It could be actually shipping back the goods, either because it's really just has a minor damage or simply because there was an error that you got the wrong product, not as what you ordered. Okay, so purchase return is a case. Purchase allowance is the case that without returning the goods, but both cases you will have a reduced amount of liability. Okay, meaning that earlier you purchased inventory $700, you thought this is the value of the goods that you will have in a few days. But then when you receive it, let's say the total value that you can actually use to resell to customer only worth $600. The 100 here either damaged or just wrong goods, not the one that you ordered. This part here will be reduced and your accounts payable will also be reduced. Okay, so this is what the allowance means. You will no longer be paying back the seller $700 in full because a part of the goods either is damaged or it's not what you ordered. Okay, but these two cases, in terms of journal entry, we don't differentiate them. But you have to know that in reality there are two different cases. In terms of journal entries, both of them will be captured under inventory. Okay, once again, for purchase returns, purchase allowances, both cases the accounts payable will be reduced. Reduced by the amount of the goods that we either ship back to the seller or we keep hold to it, but at the same time the amount we're not able to resell to other customer. So the seller typically will also reduce the amount of the value of those goods. Okay, so for both cases shares this exact same entry here. If the amount of the goods that's no longer useful we cannot sell to our customer is worth around $100, then we will be reducing inventory by 100 and reducing accounts payable. Okay, so accounts payable on the debit side means that the liability originally increased on the credit side $700, but now we reduce it by 100. Later on, we just need to pay the seller $600. Okay, the right side, $100, could represent actually shipping back the $100 worth of inventory to the seller or keep hold to the ones that are no longer useful to our customer. But we get a refund from the seller. Okay, so for both cases, we use the same entry. So far what we have here is, if we look at inventory account, the debit side we have $700 purchase entry of inventory. Right side, if we do an inspection of the $700 worth of goods and we realize there's $100 that's not what we ordered or it's no longer useful for us, we can't resell it to our customer, we reduce this amount. And And then usually this will come first, because usually when the company gets the products, they will do a quick inspection and make sure that this is what they ordered, make sure this is ready for sale. So usually this is a case that will come first, purchase returns and allowances, if any, if this case actually happens. Then later on, they will be paying the money. Okay, so if this case happens, you'll have to reduce the 100 from 700. $600 worth of goods, then you apply any discount. Okay, I mentioned discount earlier first, but in reality, after inspecting the goods, if there's returns and allowances, you usually reduce that first, because typically that happens just a day or two after the company receives the goods. Okay, then a few days later, within the discount period, likely company will be paying off the inventory amount. Then you apply the remaining value of the inventory to the discount.